Yeah, so I think globally, what we've seen in the last few years is specialized funds are becoming more of a trend, and I think this is a model or a function of funds are the whole fund ecosystem is just getting a lot more mature, and early on, I think you would see specialized funds really just looking at maybe biotech or something that was so specific that you really needed, somebody to be a doctor or something, just really specific skill sets. But now I think we're starting to see that permeate a lot. If you look at what's happening in the SaaS space, you have funds that are exclusively focused on SaaS business models. You have funds that only want to fund marketplaces. And so this is sort of a maturity factor, and I think it's for VCs. It's really about how to find some edge and how to really carve out space. And all this is enabled, of course, by the maturity of the tech scene. So it's being matched, and I think that's a great thing. In Southeast Asia, we're a little bit we're not quite there yet. Most funds here are generalist. So we're probably one of the first few that are really specialized, but we're seeing more and more of them, and we're seeing some specialist funds also now coming out to Southeast Asia, looking to see, okay, we know the playbook, we know how it looks. Let's see if we can get it done and be a part of that next wave of Southeast Asia. So that's one of the big trends I think we're seeing in this region, and I think globally, and we're probably following along or being a part of that next wave.
Then to dive a bit deeper, right? What are some of the interesting startup models that you guys are looking at, that you guys are viewing, that you see that Southeast Asia is abundant in, or that should be up and coming?
Yeah, I think the great thing is that the whole market's maturing together, and for startups, that's a tremendous opportunity. Aside from specific business models, there's some macro trends that are really helpful. The region is been a source of growth, notwithstanding this last 2 months. But demographics and growth are really positive. There's a few other things that really help the ecosystem push forward. So what we see is that, especially in fintech, that banks and large institutions and then the startups, there was a bit of skepticism traditionally between those two camps. I think just not sure how to deal with each other. And that's changing very quickly. We're seeing very large FIs now actually keen to partner with startups and learning how to partner with them very productively and introduce their products. So that's really a maturity thing that's changing, and it opens up opportunities for both. I think they need both camps need each other to be successful. The FIs here, I'm sorry if I'm using jargon. The financial institutions here, they really a lot of them are not as digital as they could be or should be, and there's now a push to be more competitive. I think we're seeing, and especially today's situation when branches are closed and offices are closed, some of them can't close because they have to do things on paper, which is really unfortunate. And so that's not an exaggeration, but it's a little bit of a it's something that's always been there, and I think now folks are going to be really keen to start to fix it up. And so what that translates into is not just partnerships with startups, but integration with startups. And I think we're going to see more solutions starting to be delivered by APIs instead of standalone solutions. As the whole system starts to become more digital and automation starts to permeate all the different roles, then that changes the way products are designed. So this is really going to benefit SaaS business models, which to date haven't been that popular. We see some trends with cloud. Cloud is still not here in Southeast Asia. We have it in Singapore, but if you go to Indonesia, AWS is not quite there yet, which is difficult for a startup. Having to put in your own infrastructure or having to work with a local data center, because it's not just it's the computing power, right? It's that service level above that allows you to really scale quickly and to test and experiment, and deploy things very, very quickly. So these are some really positive trends. If we look at where the region is for fintech, you find we're a little bit behind or pretty far behind, and not just of sort of developed markets, but also developing markets. And so we can even look at areas of like where Brazil is and say, okay, there's certain things there that have worked and they're further along than we are here. And that's not a negative thing, actually. That's a huge opportunity for startups, because there's just so many problems to solve. If you flew from Beijing or Shanghai to Jakarta, you quickly feel the difference as far as how far fintech is permeating the economy. When you go to pay for that first taxi ride, or you even buy a SIM card, you're not far out of the airport before you realize that there's just a lot of work to be done, and there's a lot of transformation that's going to be happening. So those are some of the broader themes. It would be hard to pinpoint any area of the economy where fintech couldn't touch it to make it more interesting. If you look at leading things like e-commerce, I think 70% of e-commerce is still cash on delivery. And you can say, well, yeah, but if that works, why not? But in fact, we know that it causes a lot of problems. A lot of deliveries go undelivered because simply the person doesn't have cash at that moment. So there's just a lot of opportunities everywhere and progress to be made. And there's going to be solutions that fill the interim, and there's going to be solutions that are really able to satisfy needs in the long term. And forgive the expression from probably 5 years ago, but there's definitely going to be a leapfrog effect, and there's already becoming one that we're seeing.
So then, Scott, to talk about the current day economy and how, startups and, venture capital firms are working through, the current COVID crisis. Why is it that later stage funds have stopped investing, and early stage funds are feeling like this is, to them, not so much a bear market, but a bull market for them to take on and start investing as much as possible?
Yeah, that's a really interesting phenomenon. But I think if we peel into it, it does make a lot of sense. I think there's been a misconception that later stage or is somehow safer, and in fact, they're just very different strategies. Seed investing is a strategy. There's a lot of data on it. There's what works and what doesn't work. And what doesn't work for a seed stage is to invest in two companies and then expect them both to be unicorns. So there's where or we can call it 10 companies or 8 companies, where in growth equity, that's really your strategy. So there's a few things that kind of happen here. I think one of the broad views is that as seed investors, we're investing for the next cycle. We're investing for our time horizon's a bit different. So we're not trying to flip a company to IPO in the next 12 months. We're really looking at companies that are going to grow into the next upcycle. So that's really on the face of it, the first thing. If we start to pick into the real nitty gritty, seed stage companies are just a lot more flexible. Usually there's a team of maybe less than 10 people when we would invest, and how fast they hire people is quite variable. These are companies that are looking to get their first 1,000 users or first few thousand users in some cases, or if it's a B2B company, they may have one client with a pilot and looking to get a few more. So they have a lot more flexibility if they don't get that. For sure that decisions are going to be taking longer, but at least you have that. At least you have those levers. If you have to extend out for a month or two, then you're not in such a bad situation. But I think one of the big things is that right now the growth equity investors are they're getting hammered. And so if you have a portfolio of growth companies, your portfolio is probably underwater right now. Deals that look like they were done are not done. And again, part of this is how we do an investment. When you make an investment, you look into the future and you put a valuation of where you think things are, and you discount that back. And in the seed stage, we're looking for returns that are you can't even calculate the IRR. We're looking for MOC, right? Multiples of capital. To get to the next round, we want usually a few multiples on our investment. Anywhere, if we're investing at a 2 million to get to 10 million, that's a 5x multiple, right? With late stage guys, these kind of growth equity, they're underwriting to 30% IRR, and in some cases even less. And that 30% is based on a very rosy bull market case, because we've been in a bull market for the last 8 to 10 years. So they find themselves underwater, and they don't really have the diversification to take them out, and they don't have they're not able to capture the upside, because their upside will be a 2x. And so if one of their investments goes to zero, their best investment will just make up kind of back to par. So they're really struggling. And I think the other thing that we've seen a lot is in the later stage, there's been a lot of crossover investors. These are like strategic investors, large corporates, and the large corporates are reeling right now. They're not going to be making a Series F investment in some startup so it can put off its IPO, which now is very uncertain. So the whole, I think there's like a whip effect where the end kind of gets whipped up. It actually has a bit more volatility. If a seed stage company is worth 2 million or 2.5 million, and the next round is worth 4 or 6, the real issue that we see there is how much dilution does the founder taking, and is there going to be enough runway and upside for the next round of investors? It's not so much an issue of where does the value sit. It's more of a how do we make sure that the company is funded well and alignment is existing, and the company remains both liquid but fundable in later stage when all this sort of dries up. So on the early stage, there is going to be some pressure. I think just like those strategic investors, we're going to see a lot of the angels pull back. A lot of angels have a day job. They're not full-time angels, or they have maybe diversified investment portfolios, so they've seen their public equities get hit, and they're just a bit more cautious, or they're not getting that dividend that they were pumping into their startup investments. So there's going to be a bit of a contraction there, and for a seed stage VC like us, that means that there's better opportunities available. And for the cohort that follows our investments, the Series A folks and Series B, most of them are also professional investors. They're closed-end funds. They have to put money to work, and they're actually hunting for the best startups as well, even if it seems like they're not deploying as quickly. So I think there's even some more dynamics there. If you look at some of these companies, might have to do a down round. Down rounds are very tough. There's going to be a lot of things in their financing and their cap table that